Yeah, I mean, the market's been telling them for probably 6 months that they need to hike rates. They did previously about 500 basis points, but it was always too little too late. Finally, they got ahead of the curve. Finally, they did much more than the market expected. And I think that's really positive. I mean, it's important because Turkey's problem has been an overheating economy, growth's been too high, it's fueled imbalances, particularly a big current account deficit. The market's concerned about that, and rising inflation reflective of the fact the currency has been weakening. The fact that they've raised rates very aggressively now, the base rate to 24%, I think means they've got a chance of stabilising the currency, and it will also help that rebalancing process. Growth will be lower. That will help the fight against inflation, but also help the current account deficit moderate. So, this is good news. And remember, set against a very difficult political setting, as you mentioned. I mean, just hours before, President Erdogan gave the central bank a real kicking, to be fair, suggesting that he didn't like their policy, it wasn't working, high interest rates weren't the solution. So despite that, despite the very difficult political setting, the central bank hiked rates much more than the market expected. So, they've got a lot of criticism in recent months, and I think finally they've done the right thing, and they should be commended for that.
All right, you got to wonder how much of this is just political theater, though, but maybe it doesn't matter. It has had the intended effect, at least for now. But, Tim, you were talking about the fixes still ahead for Turkey. I know you believe they can manage without the IMF. Explain to me why, because, theoretically the IMF could potentially come to the rescue with a bailout, but Turkey's problem is, as you well know as a sovereign strategist, the buildup in debt, a lot of it has been A, dollar denominated, and B, corporate, which the IMF would probably want no part of. It's just way too messy.
Yeah, the plus for Turkey, though, is it's not a sovereign debt crisis. Public sector debt ratios are very low, 28% of GDP. I mean, imagine the EU average is about 90%. So they have not much public sector debt. They've got plenty of space on the sovereign balance sheet to help banks, help corporates if need be. As you mentioned, I mean, the problem really is external debt, external financing. The rate hike will slow the economy, reduce the current account deficit, reduce dollar financing needs. And the problems that banks and corporates do need to be addressed. But there is some dollar liquidity in the system. And what's really important, actually, is relationship with international banks, European banks, their willingness to roll some of these external debts. And those comments we just heard, actually, from the BNP chairman, I think were very reassuring. And so European banks and international banks, there's very long-standing relationships with Turkey, with a lot of the entities that borrowed in Turkey are blue-chip Turkish companies that banks want long-term relationships with. So, I think the international investors and international banks were waiting for the green light from the central bank. They want a proper policy in terms of interest rates from the central bank to give them a signal of confidence to continue to roll some of those external liabilities. And I think we kind of got that yesterday.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.